Hey traders, what's going on? Todd here. Welcome to the free video update. It is now Monday night, February 6th. And question for you, do you think if you're a stock market bull that it'd actually be better if we moved into a recession? The data that we're seeing here recently and the reaction in the macro markets actually suggests that I think it'd be better if we actually started to get some weak data and we started to move closer to the idea that we are in recession, because then I think that would take some of the pressure, the near-term pressure off the Fed to continue to raise rates, which is keeping the stock market under pressure. So let me explain a little bit what I mean by that. So Friday's job report was super hot. NFP came in at 517, expectations of 187, okay? The unemployment rate was down at 3.4%, estimates of 3.6. That's the lowest since 1969. Thank goodness average hourly earnings came in at 4.4%. They're expecting 4.9. If the earnings were hot, that would have been a huge problem. Another thing here is leisure and hospitality. So services added 128,000 jobs to lead all sectors. So services continues to be a driver of inflationary pressures. Now, this just came out from Goldman. They just released this, and what they said is we've cut our subjective probability that the U.S. will enter recession in the next 12 months from 35 to 25, which is less than half of the 65% consensus estimate in the latest Wall Street Journal survey. Continued strength in the labor market and early signs of improvement suggest that the risk of a near-term slump is diminished. So, all right, well, great. So if we're in a very tight labor market. We have inflationary pressures from the services side. Maybe we're not even in a recession at all. That's going to continue to put the pressure on the Fed to raise rates, and that's just what happened following Friday's non-farm payroll. And if we look at this quickly, this is going to be the probabilities of going above 5. Right, so we were going to stop. The market was all set to stop at about 4.75 to 5 in terms of a range here in March. But now out here in May, look, May now has a 75% chance of going another 25 basis points. A day ago it was 59%. A week ago it was 40. Okay, so we are now going another 25 basis points, and if this data continues to be, let me get this white thing on my screen. If this data continues to be strong, who knows where the Fed's going to stop, and stock market might have a hard time rallying. So we need to figure out where we are in the macro point of view, and I'll show you where we are in the indexes, and then I'll show you some market capitalizations and some sort of growth industries that are performing well, where I'm trying to scare you at the top here a little bit. Maybe it's not all that much that we have to fear. So let's kind of pull this apart. All right, so after Friday's report, what happened is bonds got crushed because we had an inflationary number and yield spiked. And the 10-year yield here in green was pushing pretty well below 3%, 3.3%. It was trying to break down through this low. And then all of a sudden here, boom, we rip right back up. So that's fine. We have 10-year yields in a little bit of a consolidation triangle pattern. Well, you could see the 10-year yield has a very good standing correlation with the dollar, and specifically the dollar against the yen. And those are for global macro reasons I'm not going to go into in this video another time. I've covered it in past videos, but you can clearly see as we go back here that the relationship is very, very tight. Well, dollar was dropping against the yen. Dollar dropping is a good thing. The dollar strength, because of the early inflationary pressure and the Fed having to raise our rates much faster than the rest of the world, was choking off our equity prices. Well, now that we're starting to get some clarity as to long-term inflation expectations, we're starting to see rates kind of moderate, dollar sell off, and then we got Friday's report and yields just went ripping up. So, okay, now dollar just started to get a bid against all the other currencies. So how much higher are these yields going to go? Are we going to continue to get strong data, which is going to put more pressure on the Fed to be restrictive and choke this off, as earnings are already just okay? I mean, they're subpar earnings from very low bars and expectations, but being that the markets thought they had clarity on where the Fed is, they were giving all these companies a pass. So we're about halfway through earnings season. So just to show you, if I squish this up a little bit, and I'll bring the S&P here in this orange color down below, you can clearly see there's mostly an inverse relationship there between the S&P and yields and dollar yen. Okay, so that's that. Where are we right now in terms of the S&P? Let's take a look at the wave count here. All right, so this is the weekly, and very simply here, this is the 2022 decline. Very nice, orderly, what I think to be an ABC correction. We've moved up. We tried 4,100 a couple times in December, sold off, and finally just broke through it, right? Just last week. Okay, so if we break this down a little bit here, get a little bit more clarity. If we are in fact in a wave 3, and this is what's a mind blower to me. Okay, wave 3s typically go at least the distance traveled in wave 1, the percent distance traveled, right? So the percent distance traveled from the, the October to the December low was 17.4%. So let's do that again from the wave 2 low. 17.4% is right there at the 100%. And then the 1.618 is up here, get this, 29% rally. This is textbook for wave 3. This puts us at a new all-time high in the stock market. I'm not projecting, I'm saying according to the Elliott wave model, which is wave 3, is often a 1.618 multiple of the percent distance traveled in 1. That puts us at 4882. That's going to be a far cry. I mean, it's a lot of things are going to have to go right for that to happen, but that's what the model says. So we really need to hold above this level right here. Now, if this is not a new motive impulsive, this is how Elliott wave corrections go complex. If we have an ABC and the market says, all right, let's try to rally into a new motive wave and then kind of fails, okay, that means we're going complex, which means we're doing ABC. This becomes W. The failure becomes X, and then we go into another correction. That's going to look like this. If we cannot break, if we don't break specifically back above, this 4,200, and we stay below specifically 4325, that's going to be invalidation. We just made this updated count today. It's possible that we go triangulation before we do make another low, down around 3,300 in the back half of this year. Do I think that's going to happen? I don't. I do think we are in a simple ABC correction. The market's going to gather itself. I'll give you one more look here. I'm going to save the details for the members. But we are in, I think, to be a possible 1-2 situation. We came back and retested 4,100, which again was a major breakout point. 1, 2, 3 times failed before we finally got it on February 1st. Okay, so now we're coming back to retest. So are we going to head higher? I mean, I can show you the Nasdaq quickly. I'll do that for you real quick. Nasdaq's going to look a little stronger than the S&P because we're seeing some pretty good growth strength, and that's one theme I'm going to focus in here to finish up this video. But this was the December high, right about 12,136 in the Nasdaq. We broke above. We're coming back to retest. We're in a pretty good support here in the Nasdaq. And again, there's a lot of stuff going on in this chart, I realize, but it's very important to figure out, is this 1, 2, and we're going higher in 3, or are we going to go into an X wave and we're going to have to deal with further downside declines? All right, so let's jump over one more thing I want to show you guys. Now this is I think where the fun starts. All right, so let's take a look at this. A few things we're looking at here. This is going to be small cap to the SPY, broken trendline resistance moving higher. Mid cap to the SPY, broken higher. Consumer discretionary to consumer staples ratio going back to 2016. Boy, that looked like a nice trend line break, and then all of a sudden, boom, consumer discretionary outpacing consumer staples. So you have small caps outpacing large caps, medium caps outpacing large caps, consumer discretionary retaking uptrend support against the staples, same thing against technology against the staples. Okay, and then what's more interesting, if you combine those two things, look what's happening here on the rotation. This is a monthly. Okay, so we're going to go back to those October lows, and up here is going to be the IWP iShares mid cap growth against the S&P 500, And if we started in October, watch where the rotation goes. You got to watch quick because there's 6 different iShares on here. There's iShares, there's top 500 value, there's the mid cap value, and there's small cap value right here. Over here is going to be the S&P 500 growth, the small cap growth, Russell 2000 growth, and the mid cap growth. Watch what happens when we go from October and we start rotating here. October and then into November. Watch what's happening. See how the rotation is going. We have small cap growth, mid cap growth, and large cap growth rotating from lagging up into the improving. That is gaining momentum and relative strength to the benchmark, which is the S&P. What's losing momentum, relative strength? Value. Large cap value, mid cap value, and small cap value. So we have mid cap growth really making a move off the October lows. This guy's up 25%, the S&P is only up 20, right? And if we put it up against the value, they're going to be much less than that. So, you know, we have a very peculiar situation here. Finally, look at this. This is going to be right here. Look at these guys. Okay, these are small caps. Look at the movement here we're seeing. I have small cap consumer discretionary, small cap tech, and small cap energy. Look at this move going back to October lows. Okay, let's take a look at this. Let me flip this to the weekly. Watch this. Let me do that one again. So what's happening here? You have small cap energy falling out of favor. You have consumer discretionary looking very solid. And you have small cap tech pointing up and to the right as energy is rotating out, right? And we've broken above. Not only has small, this is going to be, what is this guy? Oh, yes. So, okay. Oh, yeah, tech, right? So not only have we broken above August highs and December highs and January highs, but we have completely broken out here. Okay, we've completely broken out of here in small cap tech. So there's some very interesting dynamics going on here. And if we could actually just get some less strong data, I think it takes the pressure off the Fed to raise rates. And finally, when we get clarity as to when rates might top off, is I think when the market might actually start going. But there's some small, medium cap, consumer discretionary, communications, and technology that are really bubbling below the surface here. So I continue to be bullish. All right, hope that helps, guys. Just a little quick update for you. Catch us over at tradinganalysis.com. If not, I'll see you in the next free video update. Take care.